Everyone can see my screen? Can everyone see my screen right now with the pre-approved in 2022?
Yep.
All right, well, let's get started here. We're going to go to the first slide. What we want to talk is what we're going to talk about today is the top concerns for current home buyers. We're seeing a lot of home buyers that are really stressed out about the market. They don't know if they should buy or not. Is there a housing bubble on the road? Interest rates just skyrocketed. It's crazy out there. So we're going to talk about those things. We're going to talk about high interest rates. We're going to talk about the lack of inventory and the high levels of competition. We're going to talk a little bit about the market volatility, and timing. Like, should I buy now or should I wait 6 months? When's the right time to buy? And then we're also going to talk about something that's been happening a lot lately. I mean, it's skyrocketed, and those are opportunities in other states as well. So we'll get into a lot of good stuff today and see where we end up here at the end of the day. Okay, so interest rates. This is the elephant in the room for everyone. So in January, just towards the middle to end of January, interest rates were hovering around 3 or just under 3%. And within about a month and a half, 2 months, we skyrocketed up over 5%. We then, at some point in there, the Ukraine war started and rates fell down quite dramatically when that happened. We dropped down to into the 4s again, but then inflation report came out like 3 days later, and then the rate skyrocketed back up. They're hovering pretty high right now. I've priced out a couple of loans today, and we're anywhere in between like 5% and about 5.5%. We've been quoting some clients, depending on credit score and equity, over 6% on a 30-year fix. So a lot of variation in there, but the rates are definitely higher. Now, what do high rates mean though? Does that mean, oh, I don't want to buy because the rates are too high? Well, let's talk about that. Cons. Payment shock. Obviously, your payment's going to be higher. Higher rate, bigger loan amounts with the higher values, you're going to have payment shock. The payments are higher. There's no doubt about that. You're going to have less purchasing power. So the higher your payment goes, depending on what your income is, it's going to lower your pre-approved amount. We've had to go through our entire pipeline and go through and re-update pre-approvals for our clients by updating their interest rate. And in some cases, it would actually reduce the amount they qualify for. So less purchasing power. It's intimidating. Like, I don't know what's going to happen. Why are rates jumping up so dramatically, so fast? So it can be a scary proposition as well from that standpoint. So we want to try and alleviate that fear through this today. And higher housing expense. I mean, obviously you got payment shock, your payment's going to be higher. But it's actually, and I meant on the higher housing expense, I meant higher interest expense. So you're paying more interest over the life of the loan. You got a higher rate, 3% to 5%, that's a 2% leap. You're paying more interest over that period that you own the loan. Now, what are the pros of the higher interest rate? And I think these are probably even more important right now. And you're still going to gain appreciation. If you get in a house today, there's no doubt in my mind that the market's going to continue to go up. I'm pretty certain it's not going to go up at the clip, the leaps and bounds that it has been over the last couple of years. But most people are predicting in the high single digits to low double digit appreciation over the next several years. And we'll jump into that a little later as well. So appreciation is king. It's a great asset to own from the standpoint of it just grows in value. We'll do the it grows in value over time, and your mortgage goes down over time as you make your payments. It shows that the housing market is strong. Even though rates have gone up, we're still seeing multiple offers on houses. The demand is still there. Now, it has slowed down. We've definitely seen some slowdown, but I feel strongly about the fact that it's just kind of like that. Something happens and you freeze. You're a deer in the headlights. So a lot of buyers are like trying to figure out what's going on, which is exactly why we brought this class to fruition. Is we wanted to talk about the market and what the opportunities are that are out there. And there's a lot of opportunities out there, in my opinion. Less competition, I think this is the most important one. The number of multiple offers has dropped significantly. I've talked to multiple realtors in the last couple of weeks. I had one that had a house in the market and it hasn't gotten an offer, and it's in Snohomish. Like, that's impossible in my mind. There's a couple other houses that had only one offer or two offers or three offers. I think there's a twofold reason that that competition is dropping. One is, again, the rates jumped and people deer in the headlights froze and they don't want to do anything because they're trying to figure out where the market's going. The second thing, though, is I think too that some people got bought out of the market. The rates went up and now they can't afford the house that they want to be in. And I think also, I think a lot of people are listing their houses higher than they should. So a listing agent sees a bunch of houses around the neighborhood that sold for, 600,000, right? But they started at like 550 to get to 600. So now this new listing comes on at 600. Now people in that market are thinking, oh my God, I got to offer up to 650 to get my offer accepted. So they just don't offer on the house. In my opinion, in that case, it was a mispriced listing. And they scared away buyers because they listed it higher than they should. In a lot of cases, and I just had a conversation with an agent today about this, in a lot of cases, it's the client seeing houses around them sell for that higher amount, and they want to list at that, which is a mistake because now it's going to jack up the higher price. You lose a lot of the competition in that category because you're listed higher than you should be. There's a lot more opportunity out there. I mean, opportunity is all about getting into a place, upgrading, selling your house, taking the cash, buying something here or somewhere else as well. Real estate always presents a lot of opportunity for people, and it's also the best wealth building tool that I can think of. So it's one of those things where you got to get into a house. If you don't own a house right now, it's got to be your number one priority, because I feel like if you don't get in today, tomorrow, the next day, a year from now, it's going to be that much more difficult. Your payments are going to be higher because the values are going to continue to go up. So more opportunity right now to get in sooner than later, because over time, we're going to have issues with even higher values and things like that. Now let's look at interest rates over this is over about the last 5 years or so. This is key to me because if you look right here, this is 2018. Rates tipped out right here, peaked out in 2018 because the Fed started raising rates. And then they raised rates so much, we hit about almost 5% then. They raised rates so much that the economy started to slow and they died back down. Now, if you look at this over here, this is today's rates up here over 5%. The problem is the cost, the yield on the 30 or the 10-year treasury right now is much lower than where it was in 2018. So what that tells me is that the market is oversold. The Fed's pulled out of the market and inflation reared its evil, what do you call it? Evil head at the same time. And the inflation spooked investors. Bonds, which are what interest rates are based on, are inflation sensitive. Higher inflation means it's degrading the yield on your bonds. Your return on your investment drops significantly on a fixed rate investment like that. So investors right now, because they saw the rates skyrocket, the inflation is really high, they're scared to get in the market. So now the Feds are not buying bonds anymore. And now investors are trying to stay away from bonds. Although yields are very, very good, in my opinion, almost 3%. It's a great time to buy bonds, but no one's buying them because there's still so much uncertainty. We've got a war in Ukraine, and we've got a inflation that's almost at 10%. So when I say it's oversold, today was a perfect example. The Feds came out and raised rates by 50 basis points. Okay. What happened to mortgage rates? They went down dramatically. We had a massive rally today, up 60 basis points, which is a massive rally in the bond market for mortgage-backed securities. And the reason for that is the Fed's raising interest rates is staving off the inflation and giving investors a peace of mind that the Feds are going to do something about the inflation and get that under control. So it's making people feel better about jumping back into the bond market. I feel like right now, interest rates should be closer to 4.5. That's how far off we are. I feel that way. I mean, I'm just Jeff over here at NFM Lending. That's me. But I've seen it before. I've compared the two looking at these charts, and that's kind of where I feel like we are. Here's another great chart. These gray lines are recessions throughout the years, going all the way back to 1960. So each one of these gray lines represents a recession in the economy. Here's our little 2020 recession. The point of this market, or this chart, I mean, is what happens during a recession. You're going to hear a lot of talk about recessions right now. It's probably all over the news. I've been seeing it. Everyone I talk to is talking about it, like in the mortgage industry and stuff like that, that we're going to come into a recession at some point. We may not, but I feel pretty good about the fact that we're going to hit that, just with what's going on with the Feds. They're going to have to jack rates. So look what happens. The Feds jack rates to stave off inflation. And then what happens right after that? We go into recession, and then the rates come down. Then he goes, Feds have to jack up rates, go into recession, the rates come back down. Feds have to jack up rates to get over inflation, come back down. You get the theory all the way down here that rates continue to go down through a recession. Recessions are very, very real estate friendly. I mean, we're all excited. Mortgage business, there's a recession coming. We're just like, woohoo! Seriously, because we know the Feds are going to push rates lower. Just like this, here's the rates are going up. This is 2018, where I said the rates were over 5%. The Feds freaked out. They pushed rates back down. We ended up going to recession. This is kind of a false recession just because of the pandemic, obviously. But even so, we go into recession. What happens? They push rates even lower. The Feds pushed them, right back down to zero. So we may be coming towards a recession. If you're in the real estate side of it, you should be excited. If you're buying a house, if you own a house, there's just going to be a lot of opportunity. All right, here's another chart. Me and my charts. And I got to thank my ladies, Sarah and Sky, for putting this all together, because these charts are awesome. So here's another one, home prices versus interest rates. So we just saw this chart with the interest rates, right? So now let's say what happens to the housing market when we hit a recession? Up, 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 and away, except for 2009, right here. This is the only recession that really had a major downturn, and that was because it was a fraudulent recession. It wasn't an economic recession. The reason this recession was caused is because mortgage banks and big investment firms were securitizing these loans that people didn't qualify for. Because of that, rates plummeted, the housing prices plummeted. But here's the thing is we fixed the market. Now everyone has to qualify for a home loan. You can't get a home loan with stated income, 100%, zero down on a 2-year fixed anymore. So what ends up happening? Home values get back on track and they start to head up. Now we had a little dip here in 2020, just in the beginning of the pandemic, because people were just freaked out and nothing was happening for like 3 months. But then as soon as we got out of that stay-at-home order, or whatever you want to call it, boom, look at that. There's a lot of positive things to be looking at right now in the housing market. And one of them is this line right here is just going to continue to go up higher and higher. There is nothing that presents any kind of idea that there's a bubble or anything like that. And there's a lot of presentation that there's going to be another recession. And anytime there's a recession, there's a dip and then a follow-up like this. I don't think we're going to have a dip, because this recession is not being caused by like unemployment and things like that. It's just high inflation. Our job market is super tight. Unemployment's at a 60-year low. Employers can't find people to work. That's how powerful this market is right now. Let's look at appreciation. Here's the median home price in King County and Snohomish County. The outlook is a 63-year average is 5.8%. The 5-year average, trailing 5-year average is 9.29%. But look at these forecasts. 1 year, 7.78%. 5-year, almost 30% gain, guys. Like, that's just crazy. That's such a great investment right there over that time. Look at a 5-year gain. You're going to gain $245,000 in equity in King County and over $174,000 in Snohomish County. And here's the thing, when you rent, you're allowing your landlord to earn this type of appreciation with your money. So renting right now, although it might be slightly less expensive than buying, is going to cost you way more. The year-over-year increase in rents from March to March of 2021 to March of 22, this is a national average, which is really scary, is 22%. That was the national increase in rents year over year from March to March. Seattle is obviously a more expensive market, so those rents are probably even higher than that. So if you're renting over the next 5 years, you're not going to get all that equity in the house. You're going to be negative because your rents are going to be so high at that point. So really want to hit the mark with get out of the rental, get into a house. We just got to figure out how to get there. And that's part of what we're going to talk about today. So let's go into inventory. A healthy market is 4 to 6 months of inventory. Right now, ours is about 0.4 months. So we're looking at most houses are selling or the number of houses we have to people is what it's right here. It is another chart. I love it. Homes for sale, 2 houses for sale for every 1,000 people. It's crazy. And we got a lot of first-time home buyers in this 27, this millennial range. A lot of them are first-time home buyers taking advantage of the market. So it's going to continue to go. We have a ton of millennials coming up. They're in the tech industry and things like that. They're going to be able to afford and continue to support this market. They're going to continue to go out there and continue to buy the inventory up. And I think there's an advantage to us here in the next couple of months with inventory that we can talk about, that I think there's going to be some more inventory in the next couple of months. And now is the time to get out there and start looking at houses. And as more and more inventory comes out, hopefully that'll slow down the competition a little more and give you more opportunity and a better selection. Next, inventory, another one, consider other states. Other states have a lot more inventory. They're building a lot faster. They don't have as hot a market as we do. So if you have the ability to be able to work remote or something like that, I mean, we'd hate to have you move out of Seattle, but at the same time, a lot of people are doing it. I get licensed in states where I see 2 to 3, 4 of my past clients start to look at properties outside the state. That started about 3 years ago, and now we're licensed in 22 states overall. So people are moving out. A lot of them are investors buying rental properties, and a lot of them are buying second homes. And the advantage is you can go buy a house in, Oklahoma for 160 grand. Not that you want to live in Oklahoma, but you might want to rent it out. Texas, Nevada, Nashville, Tennessee. A lot of those properties are starting to skyrocket in those places as well, but they're still way below the inventory, way below the price levels that we're seeing in Washington State. So we just want you to know that there are other opportunities out there. So if you thought about moving out of state because the prices are, higher, this might be another thing that we can explore. The nice thing is once you get pre-approved with us, you're basically able to buy in any of the states that we're licensed in. Okay, let's talk about timing. So a lot of people say, I'm not going to buy right now. I'm going to wait until the prices go down, or I'm going to wait until, the rates go down or something like that. That's, in my opinion, you're timing the market. You're trying to figure out when you should buy in and waiting for something to happen. I can't tell you how many times I've heard that in the last 2 years, and the person comes back and waits a year or 6 months, and then prices have gone up by 50 to 100K. And now they're really bummed, and now they're going to pay more, or they could wait. But if they wait again, guess what? The prices have continued to go up, and they're going to continue to go up. Maybe not as a high pace that they have been in the last 2 years, like I said, but still, they're going to continue to go up. This is based on a average Snohomish County purchase price of $598,000 with 5% down. Assumptions that interest rate today is 5.5% and possible lower rates in the future, maybe let's say 4.25%. Monthly payment difference is $3,403 versus $3,857. So let's say you lock in today at 5.5%, and we anticipate rates to drop down to 4.25% 2 years from now. I think it'll actually drop down sooner than that, and I'll get into that a little later. But I feel like 2 years from now, you'll pay $10,000 in rate premium, but still save nearly $85,000. So what you're looking at is if you buy today, with the higher rates, you're going to pay a rate premium for the next 2 years because the higher rate that you got is going to cost you more interest. But 2 years from now, your house value has gone up close to $90,000, $95,000. So if you minus 95,000 minus the 10, and you were able to refinance into a 4.25% rate today, 2 years from now, you just made $85,000 in value and gain over that period of time. So anyone that's trying to time the market is not doing themselves a good service. I mean, the best time to buy was 5 years ago. The next time to buy is now. And the reason they say that is the same in the stock market. When do you want to buy in the stock market? Like, oh, well, when should I buy Microsoft? When should I buy Microsoft? Well, you should either bought it in like 1986 or today. You buy now, start building equity, and then you can refi to a better rate in a year and two. Cost of waiting is brutal from that standpoint. So if you're thinking about waiting it out and waiting another year or something like that, I think you're making a major mistake, and it's going to cost you a lot of money to get there. So we definitely just want to, hammer home the point that that's where we're at. And going back to this, I'm not going to go back to it right now. I'll just go to cost of waiting. Here's another great comparison. So now if you're renting versus buying, let's look at the advantage of renting or buying versus renting. So when you start out, like I said, it's going to cost you more to rent. I mean, this is a average house in Snohomish County, almost $600,000. So your mortgage payment's going to be $3,700, but your rent's only $2,600, let's say. I think that number is probably low and going to go higher. We only used a 10% rent increase, but again, rents are increasing at an astonishing pace. They're going to continue to go up at an astonishing pace from what we know, because there's no inventory. There's no houses available, and that affects renters as well. So you look at, here's where your payment starts, mortgage, but here's where your rent starts. Now, if we scan over to 9 years later, look where your rent is, $5,600 a month. Look where your mortgage payment is. Your mortgage payment hasn't moved because you have a locked-in rate with a fixed principal and interest payment. So you're set there. The cash flow difference over 9 years is you save about $22,000 over this period of time, because even though you lose money here for a little bit, eventually you break even, and then you start making your money back over that period of time, and you get a net gain of about $22,000. I was cursoring on the wrong screen, so I apologize. So I was talking about this part over here. So you start off high, rent's lower, but then over time, the rent outpaces the mortgage payment because you're locked in. You get the cash difference of $22,447. You also get this, which is huge, $370,000 in appreciation gain over 9 years. So you just made that much in equity. But one part that a lot of people forget about is amortization gain. Amortization gain, I call this my box method, or at least Sky calls it that. So when you buy a house, you put a little bit of money down, and you got your value of the house, and then you got your mortgage amount. Over time, the mortgage balance goes down as you make payments, and the value of the house goes up. And all of a sudden, you create this massive amount of equity. So in 9 years, paying down on your mortgage, you save $91,000 in your loan balance, pays your mortgage down. So your total gain now is $420,000 is your risk of cost of waiting and renting for a longer period of time, and or equity box. Thank you, Sky. And or, maybe not buying it all and just deciding to save your money and rent instead. This is what you're going to lose out on. I mean, this is a pretty stunning number, and we're using conservative numbers in general for this. So this number is probably going to be a lot greater. I feel like the market in the Seattle market's a good 3 to 5 years gain right now, that we're going to have a run that's going to go for quite a while. And I also think we're all going to have an opportunity for lower rates later on too, with the fact that we are probably going to go into another recession. The Feds are going to push rates down. I wouldn't be surprised to see rates in the 3.5, 3.25. I heard one guy was, I don't know how good he is or not, but he was presenting a number of possibly the lowest rates we've ever seen. So I'm not sure that'll happen, but I feel pretty confident that rates will come down into the low 4s and potentially into the mid 3s, and give us a great opportunity to get out of these higher rates down the road. Maybe you have built up a lot of equity, which is definitely going to happen. I mean, maybe not a lot, but you're going to have some more equity, and that could potentially allow you to remove your mortgage insurance and give you a lot of other options down the road. Just reducing your rate on a $500,000 loan by 1% is a, you know, a $350 to $400 a month gain. Pretty massive savings, and can put you in another boat. So a recommendation I give to a lot of people if they're considering waiting is, you know, maybe take that little leap, extra $300 a month payment, go a little higher than your comfort zone, you know, make it work for a year, year and a half until rates come back down, and then refinance into something better and save that money, and then get down to the payment where you want it to be. So I'm going to stop there on this part. Does anyone have any questions? Do we have any questions to answer right now, or is everyone being quiet over there? Nice. All right, we're going to go into competition, getting realistic. Okay, we're going to cover a lot of things in this, so this is going to be interesting. But this, you know, a lot of people watch HGTV and those home shopping shows where you go in and they look at 3 houses and they find the one they want, they make an offer and they win it. This is not HGTV. This is not even close to HGTV. It's probably one of the most frustrating markets I've been in the last 30 years that I've been doing this. So how hot is Snohomish housing market? 99 out of 100. Like, holy crap, that's crazy. Most homes are getting multiple offers, often waived contingencies. Average home sells about 12% above list. Hot homes can sell for more than 20% above list price and go pending in around 2 days. So what does that mean to us? One, we need to be able to move quickly, and we got to be competitive. Current average homes listing for 4 days, market in the 4 days. That's still pretty current. We are starting to see some slowdown in that, which is a good thing. Mainly because, like I said, I think some of these houses are being mispriced initially, and then they end up selling a little longer because of the misprice. You will not have as much negotiating power for the seller for like improvements and closing costs and coverages like that. Most homes are going to get multiple offers, often with waived contingencies. I don't like waiving contingencies, but I feel like there's ways we can work around the contingencies, and we'll get into that on the next slide. You'll likely buy a starter property, move up into your dream home in the future. So what that means, we call it our starter strategy. Basically, it's maybe you go out and you think you want to buy that $800,000 house, but there's massive competition up there. So maybe you can find a house that's a little less expensive. Maybe it's not the perfect house in the perfect location, but if we can get you guys into a house today to start earning that appreciation, it puts you in a better situation even 2 years from now. Now you're not waiting. You're taking advantage of the appreciation. You're gaining equity. And then maybe in a year or 2 or 3 down the road, when you're ready, you can sell that house, take a huge gain off of that equity that you made over time. And yeah, prices on the outside are going to be more expensive, but maybe the market turns a little bit and becomes more even out and gives you a better opportunity to get into that dream house that you want to get into. I think there's a lot of that down the road. I think appreciation, 3-5 years from now is going to be slower. It's not going to be 20%. It's probably going to be more like 5, 7, 10%. So you're going to be able to keep up with this huge down payment that you get from the gain from the sale of your house. So we want to take advantage of that starter property. So if you're frustrated with the high payments because of the high rates, drop your expectations slightly, find something that's a little less expensive just to get into something so that you can own and start taking advantage of the appreciation, and then look forward to the future of lower rates and potentially even, a slower appreciation down the road to buy that dream house. Okay, competition offer strategy. So waiving contingencies. I hate waiving contingencies, but there's ways to waive contingencies and still kind of keep your mentality safe, so to speak. So a good way to waive a contingency. So one is inspection. I hate waiving inspection because I feel like that's a really important one, especially for first-time home buyers. But a lot of houses are having waived contingencies, waived inspection. So one way around that is to do a pre-inspect. A pre-inspection would allow you to get an inspection done before you make the offer, before your mutual contract or mutual acceptance, and allows you to inspect the home, but usually it's just the big ticket items. So it might be the furnace, the air conditioning, the plumbing, the electrical, the crawl space, and the roof. They check the major components of the house to make sure that there's no major issues there. The cost of that is usually about 60% of the full price of a inspection. So it could be around 400 to maybe a little higher than that. I've seen some from 350 to as much as 450, depending on the size of the house. I mean, a bigger house is obviously going to have a higher price. But if you get that inspection back and you feel comfortable with that, then what you could do is waive inspection, get into mutual acceptance, and then you got the house. You can also complete the inspection after the fact, send the inspector back in to complete the little nitpicky items so that you can get a breakdown of what you need to pay attention to on the house in case there's anything else that you might need to take care of once you buy the house. But typically I've had pretty good luck with that with buyers, that they're able to get in and feel comfortable and there's no major issues after the fact. But there is some risk, obviously, because you're not doing the nitpicky items, but I would feel pretty confident personally if I had a pre-inspection done. Sometimes the inspection, the seller will have an inspection done on the house. And if you feel comfortable using their inspection, then you got a full inspection with them, and then you can use that and waive inspection on yours. The downside of the pre-inspect, obviously, is once you once you pay for it, if you don't get into mutual acceptance on a contract, you just spent money. And if you continue to do that, obviously you're spending money to try and get into a house. The thing is this market demands that, unfortunately. You got to spend money to make money. You saw all the appreciation numbers. You saw everything we've been talking about leading up to this of the money that you can make in owning a house in this kind of a market. And sometimes you got to spend money to make money. Now, typically, I don't see a lot of pre-inspections on the lower end of the scale, say 600,000 and less. And then when you start getting in the higher end, 600 and higher, you start to see more and more pre-inspections. And when you get into the jumbo mortgages over like $1 million to, on up, you start to see inspection waived completely no matter what. And then a pre-inspection is either a necessity or some people just waive and hope for the best in some cases. So I don't like that idea at all. Another huge tool that I've never heard of until about June of 2020 is 22AD. 22AD is the 22 additional down payment. It's a addendum to the purchase and sale contract. Basically what the 22AD is a guarantee to the seller that you're willing to cover a certain amount above a low appraisal. So for example, if you're buying a house for $650,000 and the list price was $600,000 and you did a $20,000 22AD, and let's say the appraisal came in at $600,000, the new purchase price on that situation with the 22AD would be $620,000 because you guaranteed the seller 20 grand over and above a low value. So you would do your loan, we would base your loan on the $600,000 appraised value. So if you're putting 10% down, you'd put 30 grand down there, but then have to come up with an additional $20,000 because of the 22AD. Now, where I like to use the 22AD a lot, and it's really powerful, is if you're coming in to buy a house and you've got 10, 15, 20% down, when you go in and make your offer, you do the 22AD and you just decide to put less down. So you can put 5% down. I'm sorry, is everyone muted on here? Am I muted? So when you put 5% down or something like that, lesser down, then use the rest of your cash to support a 22AD offer. That 22AD is pretty powerful. I think that's probably one of the most powerful tools a lot of our home buyers have is that 22AD, just giving a little guarantee. Here's a cool fact though, on the 22AD on low appraisals. So we had our appraisal company do a study of our appraisals that we ordered last year in 2021. And so we did about, I want to say over 1,000 closings last year between the two branches in my office. And so they looked at all the appraisals that we had, and 4%, only 4% came in low on purchases. And of that 4%, I think it's 67%, I can't remember exactly, so don't quote me on this, but it's a very high percentage of the ones that came in low were the ones that were bid up over $100,000 or more. So again, if we're at 600 and you bid up to 650, there's a pretty good chance that that's going to come in at value. And here's the thing. with a 22 AD is it does benefit the buyer in so many cases. Because if you actually do bid up and the appraisal does come in dramatically lower, but you're only on the hook for a small percentage of that. Like in my example, you bought the house for 650, it comes in at 600, you get the house for 620, you just saved $30,000. So a 22 AD is actually a great tool as long as it comes in that. Now, if it came in at exactly at 620, you know, you're at 640, you still save 10 grand. If it comes in at 650, you get the house and you get it for what the cost was at that time. More than likely, it'll be that last one, but I've had several buyers, not a ton, but I've had several buyers that have gotten a deal out of it using a 22 AD because they bid up high. Most of them were well over $100,000 bid, by the way. One was 150,000 over, and the house appraised at 120,000 low. And then they came up with an extra 60,000 in between and got it, but they saved like $80,000 or $90,000. I mean, it was a great win for them. They were excited about it because they saved so much money on the price. So a 22 AD can actually work to your benefit as well on top of everything else. Not only help you get your offer accepted, but also put you in a position that comes in low, you might be a winner on that. Down payment and earnest money come into it as well. I mean, you do want to have a larger down payment. I'm on the fence of whether I think, 20% down means anything. I've been doing this for so long that I've seen, as many 20% down loans fall apart as I do 5% down loans or 0 down loans. I mean, we don't have deals fall apart at all. It's super rare that anything like that would ever happen. But more cash does show, more down does show the seller that you're a stronger buyer. However, I'm on the camp of, I think earnest money is more important. Feel like earnest money is a powerful tool, and it's kind of your first intro to the listing agent to say, hey, look at me. So earnest money is typically 1% of the purchase price. So on our example, 650, you'd put 6,500 in, and that would be your earnest money as part of your offer. What I would do personally, if I was putting 5% down, let's say that's 30 grand is 5% down, I'd put the full down payment in earnest money. Like, here's my 5% down offer, but I'm going to give you my 5% right now in earnest money up front to show you that I'm a solid buyer and I've got all the money ready for the down payment. Because the biggest concern with lower down payment offers for the seller, they want the thing to close. And if it's a lower down payment, they're concerned that it's a weaker offer. But when you put that much money in earnest money, it makes it a super powerful offer. Now, earnest money could be at risk. So we have to be super careful when you put that kind of earnest money in there. So one, you want to make sure you're working with someone that knows what they're doing. That's obviously super important. You want to be underwritten before you do something like that, especially if you're waiving contingencies. And you want to make sure that it's the property you want. We don't want to get into a property, get accepted with your large earnest money, and then all of a sudden you're like, I want the one just down the street that just went for sale. So you got to be pretty determined that that's the house you really want if you're going to put a ton of earnest money in there, because it's going to be hard to get out of that contract if everything goes as planned. And now you're trying to get out and you got a ton of earnest money in there. If you only put like 3 grand in there and the next house came up on the market and you're like, oh, screw that, I want that house. You could pull out, maybe lose the 3 grand, but if the other house is worth that much more to you personally, it might be worth doing, just walking away from the 3 grand. And I've had that happen. I mean, you'd be surprised at how many people have walked away sometimes from deals where they get sucked into a house because they just want that one. And then another one comes up that they love, and then they go for that and pull out. And sometimes they lose their earnest money, sometimes they don't. But we want to be serious on that. But I really think we pull a lot of our listing agents after, I try to call every listing agent after we close. And I want to find out how our processes went, but I also ask them, like, why did you accept our offer? And the top things are earnest money, realtor, mortgage person. Those are the top 3 things. Not necessarily in all that order, but they always come up over and over again. So having a fantastic team behind you is one where I really got to stress this. You need to have a good realtor partner that knows what they're doing, knows how to negotiate. I can't tell you how many times I've worked with people with agents that I don't know, and they'll just submit the offer, email it in, and cross their fingers and hope that they accept it. Versus some of my top realtor partners that I work with, they're talking to the listing agent multiple times, sometimes daily. During the process, right before a review date, they're calling them every day. Hey, how many offers do you have? What is your seller looking for? Do they have any move out dates that they're really looking for? Do they need a longer close, or are they thinking a shorter close? You know, that kind of communication is gold. That's money. Listing agents do not want to work with somebody that's not going to be attentive to the business and take care of business on their side, because then they have to work harder. So I think it's super important that you have a really good realtor that knows the market, knows how to negotiate, is going to work hard for you to call that listing agent, find out exactly how the offer needs to be structured, and then they're going to come back to you and let you know what you need to do in order to get your offer won. Now, once that offer is submitted, they're going to let me know, hey, Jeff, we just submitted an offer to this person, give them a call and sell us. And then I'm going to call them and sell you guys as well. I'm going to tell them you're fully underwritten. I'm going to tell them that we verified all your cash. We've verified your income. I'm going to tell them you're great clients. And then I'm going to tell them about our process that, in my opinion, is second to none. And I'm going to tell them we're going to close on time. And I always end with, this is going to be the best experience you've had in real estate. I promise. I'm going to sell hard for you guys to win it. So you got to have a fantastic team behind you. Now, on top of all that, if you got a great realtor and you got a great lender, and your realtor comes to you after negotiating with the listing agent to figure out what the best offer is, and then they come back to you and say, here's what we need to offer if you want to win this house. And you say, I don't want to go that high. How about we just go to 630 instead of 650? Basically, what you're saying is, I don't want the house, because you're not going to get your offer accepted. If your agent comes to you and tells you what you need to do, you got to listen to them. That's probably mistake number one of most first-time home buyers, is they sit there and they make offers and they're scared of the market. They don't want to go overpriced. They're scared of the payment, the interest rates, and everything else. So they lowball the offer a little bit, and it's just enough for that they lose out. And then what ends up happening, and this happens so many times in the last 2 years, is they lose out on 5 or 6 offers because they're offering list price or just over, and they don't want to go any higher. And the next thing you know, they're finally like, oh, I'm so frustrated. I'm going to get super aggressive. Then they go get super aggressive, and guess what? They get it, but it wasn't the house that they really wanted, that they missed out on 4 or 5 offers ago because they didn't get aggressive. So everyone on this call, if you're buying a house and your realtor tells you to make an offer, and they're telling you, if we want to win it, you got to do this, then you just got to make a decision. Do I want to win it, or should we pass on this one and move on to the next one? I think that's an important question that you got to ask yourself. Do we want to win it or not? If you want to win it, you got to do what your realtor tells you to do and just go for it and jump in and, you know, ride the wave of this appreciation that I feel strongly is going to happen over the next several years from that standpoint. Do we have any questions on this? I think this is an important screen, actually. I'm just going to come back to this one really quick. Anyone have any questions on that? Was there any questions in there?
I do.
Go for it.
What about the FHA approval? How about that?
Yeah, FHA loans are a little more difficult. I think it's mainly because listing agents don't understand, you know, what an FHA loan does. FHAs do have a little, they're a little more strict on the appraisal part of it. So there can be some issues with it. So what I've done is, I feel like if you work with the agent and lender, you know, I would talk to my agent and say, hey, we're going to have to go in FHA on this one. Have you checked out the house? Is there any issues on the house? And basically issues with FHA, in my opinion, are just safety and health issues mostly. But one tweaky thing on FHA that bugs me is, if you have peeling paint, that could get called out in an FHA appraisal. So we just need to know that the house is in decent shape, and then we can make a really strong offer even with an FHA loan. I mean, we've closed 7 FHA loans in the last 3 months, all in competitive situations. We just had the best offer, even though we had an FHA loan. But the house was in good shape. There was no issues on the value. The appraisal came in fine and everything worked out good. Same with VA. VA is a very similar thing. The veterans loan, very similar. They're a little harder on appraisals, so there can be potential issues. So when I'm working with VA clients or FHA clients, I'm wanting my agent, when they go look at the house, I want them to inspect the house. I want them to see if they can find any kind of deferred maintenance or any safety and health issues. Things like a deck. If someone has a deck and it's kind of falling apart, a little dilapidated, that could easily get called out as something that has to be fixed because it's a safety and health hazard. That's something that could potentially get called out on a conventional loan too, as well. So it's probably not as big a deal on something like that. The peeling paint one is one that comes out all the time. Not all the time. I mean, when there's peeling paint, it can come up. But if the house is in good shape, I wouldn't see any issue with FHA. Again, it's all going to come down to the team around you. The realtor's got to sell it. Hey, they're FHA, but this is why. They're really strong buyers. You know, and again, I think on an FHA loan, you really want to do the higher earnest money as well, because again, that's going to help sell that you're not a weaker buyer. I think FHA is looked at as a weaker buyer, same with VA, because you're putting so little down, and FHA is more of a quote unquote first time home buyer program, but in reality, it's more of a lower credit score program. People that have under a 680, typically we start to push them towards FHA is because it's a better deal. The rates are better. The mortgage insurance in a lot of cases are cheaper. So you want to go that way. So even if you could go conventional, probably makes more sense to go FHA on something like that, depending on how big the payment difference is from that standpoint. So I get what you're saying. It can be tough with an FHA loan. There's no doubt about it. I'm not saying it's going to be easy, but I'm definitely telling you we can win. We just got to use some of these strategies that we're talking about. Like FHA at 22 AD helps a lot. That'll probably erase a lot of the fears of dealing with an FHA loan if you have a 22 AD. Or, you know, maybe it's a $600,000 house, you're putting 3.5% down and you put $25,000 in earnest money in, a large earnest money deposit. You're going to need the $25,000 anyways when you're buying the house. You need the 3.5% down is like $19,000, $20,000. Then you got closing costs on top of it. You're probably looking at $25,000, $28,000 total out of pocket. You put $25,000 in earnest money, you end up only having to come up with another $3,000 to close. But at the end of the day, you made a really strong offer because you have high earnest money. I mean, earnest money, I think, is really important. So if you're putting money down and you have the money in the bank, in 30 days, once your offer gets accepted, you're going to have to come up with that money anyways. Why not give it to the seller today and show it to them to show that you're a really strong buyer and make your offer even more successful that way? And do you see people doing, Bob said, or Bobby Welsh said, do you see people doing a 22 AD along with putting down earnest money? Absolutely. I mean, the 22 AD doesn't come into play until the value comes in. And if it comes in low, if it doesn't come in low, there is no 22 AD. That just kind of gets thrown to the side. But the earnest money can go towards the 22 AD. Earnest money does go towards your down payment and your closing costs. It's not like you're giving the seller a chunk of money up front and then have to duplicate it later on and close out everything. That earnest money that you're giving the seller up front to hold the house while we complete the financing, that just goes into the transaction. That can cover closing costs, that can cover down payment, and that can go towards your 22 AD as well. So yeah, I would do that. I would do a massive earnest money, and I would do a 22 AD if you can afford it. I mean, it's all about affordability too. You know, I've got plenty of clients. We do a lot of down payment assistance and things like that. And, you know, sometimes we even need closing costs, but they somehow get into contract. We find the right house at the right time and we get accepted and we close it, and we even get seller concessions in some cases. It's pretty rare, but we just had one. That was a bond loan that we needed like $8,000 in closing costs, and the seller, we negotiated up, we paid a higher price for it, and then negotiated the 8,000 in, and they didn't have a lot of offers, and they wrote a letter, and they wrote a letter to the seller, and the seller chose them over a higher offer. That's a win. I had to sell the crap out of it because the agent called me and drilled me on, I need this to close. My seller really likes you, but if this doesn't close, you know, it's going to be, you know, not good. And I said, no, we'll close it. They're good. And we got it. So there's opportunities out there. You just got to be working with the right team. I think that's huge on that whole thing. Was there any other ones in there? Okay. Volatility and best practices. Don't change your income or status. So this is more just FYI to, as you're getting, if you're pre-approved or you're moving through the process, you never want to change your income or your credit status. If you ever have to change something, like change your job, or if you need to buy something or furniture or a car or anything like that, make sure you do not do it without telling your lender. It's so important that we're on the same page on that stuff, because we don't want you to go into contract, put a ton of earnest money up front, and then have the financing fail because we didn't know you just bought a brand new, you know, Mercedes G55 and you got a new $4,000 a month car payment. We don't want that to happen. So just make sure you're working closely with your lender and keeping them in the loop on any changes that you're making there. Don't submit an offer with an outdated approval. Again, you got to put your best foot forward. Got to have updated pre-approvals. You got to have your team calling and going crazy on them to make sure there's great communication. Luckily, our pre-approval letters, if you open them on a desktop computer, the date on the letter actually auto updates every time you open it. And we did that on purpose because we want the listing agent to see only a brand new letter that's fresh off the presses, or so it looks like it's fresh off the presses, to give them the most up-to-date information from that standpoint. And here's one important thing, guys. Do not let the media spook you. I don't know how you guys feel about the media right now, but I feel like I have no clue what's going on in the world because I don't trust the crap that comes out of those sources. It's the same with the housing market. They take a report, they pull a small piece out of it that's the worst negative piece that you can find, and then they do the story, the blow up story on it. The sky is falling. But then if you analyze the report that they pulled that piece out, it actually says that the housing market's healthy, everything's going, and then appreciation is going to continue on. So even interest rates, the way they talk about interest rates on the media and stuff, they just have the wrong information and they're not experts in the business. So if you ever hear something through the media and it spooks you or gets you a little upset or scared about the market or anything like that, reach out to a professional and talk to them and get their say on it, their opinion on it. Because I'm pretty sure that it's going to be a lot different than what you hear out there. Now, what you want to do is you want to protect your purchase power. So a couple ways you can protect your purchase power is you can do a lock and shop. That's a new program that we just rolled out. That's where you can lock your rate for up to 90 days and also have access to an additional 30-day extension. It allows you to lock in the rate today so that you can go shop for a house in confidence that that rate's not going to go any higher. And then the cool thing is once you get into contract, you get a one-time float down, meaning that if rates drop significantly, you get to float down to the lowest rate of to a lower rate that might be available during that time. Now there is a downside to the lock and shop, and what that is when you lock, you're locking on a 90-day lock. So that's a long lock. It becomes more expensive. So just an example, if today's rate's 5%, a lock and shop rate is going to be 5.25 approximately, about a quarter higher. But when you get to the end of the process, you might be able to float down to lower rates. So let's say you lock in at 5.25 and rates drop down to 4.5. Do you get 4.5? No. A float down means that we locked you in to protect you from rates going up, but since rates drop so much, we're going to allow you to float down somewhere in between. So a float down lock might be you locked in at 5.25, rates dropped to 4.5. Maybe you get to float down to 4.875 or 4.75. You're not going to float down all the way to 4.5. Now you might be able to pay some points to get down that low, depending on where the market is. But a float down is always going to be somewhere in between where you locked and where the lowest rate is. That's one of the reasons that I like the lock and shop. If you like the lock and shop, if you're not that big into the lock and shop, I hate the lock and shop. One, I think rates are going to stabilize and go down. Like I said, I was waiting for the feds to raise rates because I wanted to see, I had to see my theory if it was going to come true. I was going to have egg on my face if it didn't come true. And sure enough, they raised rates. The mortgage market's skyrocketed, up 60 basis points, a massive move. And it's because the market's oversold. I think if we wait another month, they might come down even a little more. So I would not lock right now and do a lock and shop because I feel like rates are a little oversold right now. And I think they might float down a little lower or stay at least the same. I mean, the next couple of hikes in the Fed have already been built into the market, way overbuilt into the market, in my opinion. And the Feds could raise rates probably, a full 1.5% to 2% more. And then we'd finally catch up with 2018, which was still not over 5%. So that's kind of what my theory is on that as well. But if you can't sleep at night when you're shopping for a home because you're worried that the rates are going to go up, the lock and shop is a great protection tool to give you a peace of mind. Update your approval before making offers. This has happened in the last 2 months just because rates have spiked so much. Buyers would come to us and say, hey, I'm going to make an offer on this place. They make the offer, don't tell us. They don't come to us and tell us. They just go make the offer. I'm sorry. And then they get their offer accepted, and all of a sudden they come to us and we're saying, oh yeah, the rates went up to 4.5, or now they're up to 5. Now they're up to 5.5. Now they're down to 5. They changed so dramatically. every day. If I can go back to that screen. Where is it? I mean, look at the interest rates. They just all over the place. All these little jags are up and downs every day. Yesterday, we had 3 rate reprices. Rates went up, then the market came back and the rates went down. Then the market went even down lower, and then it closed. So if you would have called me at 9 o'clock in the morning, I would have gave you 1 rate. You would have called me at 2 o'clock in the afternoon, I would have given another rate. And if you would have called me after 4:30, I would have given you a different rate as well. That's how often they change. So we can't keep up with the changes on the market. So the best thing to do is communicate with your lender right before you make the offer for 2 reasons. 1, get an estimate so you know exactly how much it's going to cost you. What's the cash to close? What's the interest rate? What's my payment going to be? An updated offer will also update the taxes so you can have a good estimate of what your monthly payment's going to be from that standpoint. And then secondly, we want to strategize on our best method of making the offer. I want to work with you guys to find out, okay, what are you offering? How much earnest money? I want to know because I'm going to end up having to talk to the listing agent and sell them. But I also want to know to see if I can give any tips. And I also want to know what your agent is telling me, what you guys are going to do to get your offer accepted so that we're all on the same page. So I think it's really important in this market to get together right before making an offer to strategize. Then lastly, I've talked about it multiple times, have your lender call the listing agent. It's stunning how many times I've talked to a listing agent and say, the reason we accepted your offer is because you were the only lender that called me. Like, what? Like, I thought that was just standard practice to call the listing agent. On the flip side of that, a lot of times the reason the lender is not calling is I'll work with an agent that I've never worked with before. They'll make an offer without us even knowing. And then I have no opportunity to talk to the listing agent. And I think it's hyper important for the lender to call the listing agent and sell the financing. They need to be comfortable with your offer. And if I call them up and I give them a lot of comfort, guess what? Our offer is going to float to the top and say, the listing agent or the listing agent's going to go to the buyer or the seller and say, hey, I talked to this lender. They're solid. This offer is a little lower, but I feel really confident about this over this other lender. We haven't heard from the agent or the lender. We don't know if they're going to close on time or what's going on. I feel like this would be a better offer, even though it's $5,000 or $10,000 less. So having your lender call the listing agent is money. Some of the other things that we're doing, and we just talked about the lock and shop. I think that's an interesting program. Like I said, I'm on the fence as far as whether I would want to use that. I would mainly use it just for, peace of mind for a new buyer to protect their purchasing power, especially if you're on the lower end of it. Locking in on lock and shop would probably be good because if you drop a little even more lower, there might not be a market there. So I feel like if we get you in, get you pre-approved, but you're on the kind of lower end, which is fine, we do want to protect that buying power. And I think that would be a good opportunity to lock it in at that point. We're also offering a closing assurance certificate. This is a new thing that we just came up, guaranteed for $5,000. So we'll pay the seller up to $5,000 if we don't close on time to cover any moving costs or any costs they incur because we didn't close on time. We'll also offer up to $5,000 to the buyer if we don't close on time, where we'll pay any moving expenses or any expenses that you come in front of because we didn't close on time. The only problem with this flyer is I'm not going to pay it out because this comes out of my pocket and I always close on time. So that's not going to happen, but we're doing it to strengthen your offer. We're attaching these to your pre-approval letter to really put your offer out there and strengthen the heck out of it. I sell it when I call the listing agent, and it's a very good assurance letter that can help us get our offer accepted. Short close is another great one. If you're already underwritten with us and we have you pre-approved, we can go to a 21-day close where we can close a lot quicker. And that could put our offer ahead of anyone else that's out there, potentially even get our offer accepted with a lower amount, just because the seller wants to have a quick close and get out of the house sooner than other ones. So a 21-day close is an awesome opportunity to get your offer accepted and get into the house of your choice and really put us up there at the top of the range. All right, guys, questions? Take you off mute. Fire away if you have any questions on anything we talked about. We can revisit any of these charts that we've looked at in the past. Would love to hear what you guys have to say.
All right, I got a question.
Yeah, go.
All right, do you got other teams in other states like Texas, Ohio?
Say that again, like other teams, like other realtors we work with?
Yeah.
Yeah, we got realtors in different states. It depends on the state. Down in Texas, we have one. So if we don't know anyone, I have other offices there that we could ask for referrals for a good agent to work with, someone that's going to be really strategic with us, like I was talking about earlier. I think the real estate agent is super powerful in this process, and you have to have a really good agent in order to get your offer accepted. I hear the feedback all the time of negative experiences with buyers agents because they just don't communicate very well or they don't reach out. But yeah, any state you're going in, I can reach out. I got tons of people in all these states that we can reach out to get some good referrals in certain areas. We want to try and get a realtor that's kind of in your area. Obviously, we don't want to get, a realtor in Houston making an offer in Dallas. That doesn't help us very much. We want someone more local in that kind of case, to make sure that we have our best foot forward. So I could track that down for you though. If you decide you want to look in Texas or wherever, let me know and we'll find somebody for you for sure.
All right, cool.
Beep, beep. Anyone else have any questions?
I don't want to take up a ton of time, Jeff, but I'd love to just back up something that you mentioned.
Yeah.
And that is just the lender calling the listing agents to kind of let them know what a strong buyer we've got and that we've fully pre-approved the loan and received all the documentation up front. I called the listing agent the other day. I think I took her off. I kind of caught her off guard. And so it was a little bit of an awkward conversation because I couldn't tell how she was taking the information. And the next day she calls me back and she says, I just have to tell you that in the 25 years I've been a realtor, I've never had a lender call me and let me know what great buyers they have. And
Wow.
she just said, and we won the deal for our clients. And she was just so thankful. She just wanted to thank me. She says, I've never had a lender do this. And it was just so appreciated. And it was just so good to hear from her. So it really does make a huge difference if you've got a lender that will make those calls and go to bat for you.
No, that's awesome. And for those of you who don't know, Julie's on our team. She's our pre-approval specialist, but also a fully licensed loan officer and does, step in a lot of cases to help us out that way. But that's just a perfect example. We've won offers just because of us calling and setting the stage of this amazing experience that they're going to have. And a lot of times, not a lot of times, I take that back. Many times there have been opportunities where we've won the offer and we weren't the highest offer because they'd rather work with us. The listing agent has a lot of power in which offer the seller chooses. There's always going to be that seller that just wants the highest offer and they don't give a crap about anything. But a good listing agent is going to control the transaction. They're going to, they're going to have 20 offers, but they're going to have your offer right up in front. Like, here's the offer I really like. Let's go through all these other offers. And our offer is just sitting there and they're going through and then say, so I think we should go with this one. Which one do you want to go with? Like, she's going to direct that person to accept that offer depending on which way they want to go, because they want to work with professionals. That's why I said, remember the top 3 things listing agents are looking for when I call them up. Top 3 things are, I want to work with a professional agent that knows what the hell they're doing. I want earnest money that makes the borrower look solid so that I know what I'm getting into and I can sell my seller on a good earnest money deposit. And then I want to work with a good lender. I need to make sure we close on time. And I need to know that this guy knows, or this guy or gal knows what they're doing, so that I don't get screwed 3 weeks in and the deal falls apart. Now I got to relist the house. I mean, holy crap, what a pain in the ass for everybody involved, but mainly for the listing agent. She's got egg on her face because she's supposed to be vetting out the offers and make sure that it's going to close. That's her job or his job. And if that happens, they look like crap. Their seller's going to be pissed off and they're looking at them like, dude, why did you let this happen? And blah, blah, blah. So it is very powerful to have that great team around you, but even more powerful, like Julie said, to have us call the listing agent. It works. It helps a lot. Any other questions? Awesome, guys. Well, thank you so much for being on. I hope you got something out of this. If you have more questions down the road, like after you jump off and you want to talk some more about it, I would love to talk with you. So just give me a jingle on my cell phone. I'll put it. Can someone put my cell real quick in the the chat if you want it. Most of you know me, if I think for the most part, so you probably have it somewhere, but I would love to talk to you guys about the market. I've got even more information than that. I got cut off by Sky and Sarah. They said no more for you, brother. So if you want my full story, my economic agenda, I could probably do it in 20 minutes over the phone. But I
Hey,
do
Jeff, can I ask you one
want to
quick
tell
question?
everyone on this is a great market. I feel super happy about this. I feel like people that are getting in right now are getting a good deal. And now if you wait about a year or a year and a half, interest rates are going to drop. And guess what? Everybody and their mother is going to be jumping back in the market. It's going to be multiple offers again. And if you're in a house by then, you're taking advantage of the appreciation that's going to jump up. If you're not in a house, it's going to be a little more difficult to get into a house. I think you'll still have the opportunity to grow on the appreciation. And yes, I think you're going to have a great opportunity to get a lower rate, but I still feel like that loss for that year and a half to get there of equity is going to outweigh any kind of gains you get in a year and a half from now. So just that's my take on it from everything that I've seen. So thanks again, guys. Appreciate you all for jumping on. Have a fantastic night and reach out anytime you have questions. Thanks for watching.
Thanks, Jeff.
You're welcome.
Thank you, Jeff.